Hello, dividend growth stock investors. Happy Sunday to you and happy birthday to DGI Crab. That is right. I am celebrating the 1 year birthday of the DGI Crab channel. I am very excited to be passing this milestone and moving into year 2 of the DGI Crab. Just like with dividend growth stock investing, I think having a YouTube channel is mostly about consistency and continuing to show up day in, day out, week after week, and building up a viewer stream just the same way that you would build up dividend stocks. Nothing happens overnight that's really worth it. And I definitely did not get into doing a YouTube channel for the money or for any kind of notoriety. I'm just happy to have the subscribers that I've got. I do hope that you will tell your friends out there and help this DGI Crab channel grow even more going into year 2 so we can continue to work together to spread the good news of dividend growth stock investing and achieve financial freedom. Let's help each other become better dividend growth stock investors. So, guys, this has been kind of an interesting week. The stock market on the whole has done pretty well. Obviously, there's always going to be some winners and some losers in the market week in and week out, but it feels like there's a surprisingly small amount of turbulence in the market this week, considering all of the things that are going on with the conflicts continuing on in the Middle East. But I'm not going to complain one way or the other. If the markets are up, makes the portfolio overall value look pretty good. If the markets are down, then there's that many better buying opportunities out there to get that passive income. It is win-win either way when you're a dividend growth stock investor. So, I'm not a professional financial advisor. You should always do your own due diligence before you invest your hard-earned money. I'm not offering direct financial advice. You should consider this primarily for entertainment. I am just sharing my personal strategy and the way I view the markets with you. And as a reminder, my personal strategy week in and week out looks exactly like this. I put half of my new money into age appropriate ETFs for automatic diversification. And for single stocks, I'm looking for ones that are yielding at least 30% or more above their 4 year average yield. But not just any stocks. I am looking primarily at the 60 individual stocks that this channel has narrowed its focus down to and then split into 4 separate categories or tiers based on the age and timeline of the investor. Now, I do have a top 10 favorite stock list. And for those particular stocks, I don't need as good of a deal. If I can get 20% or more above the 4 year starting average yield, I'm thrilled with it. Sometimes I don't even need a deal that good for my personal top 10. But for everything else, 30% or more. And if it's outside of what I think is appropriate for my age tier, I will wait to invest in that unless it's yielding 50% or more above the 4 year average yield. And finally, if there's not a buyable stock within my age tier, I don't invest less. I just put more into the ETFs for that particular week. All right, so moving into the list of the stocks here, we're going to start in tier 1, which is for the 18 to 30-year-old investors. This group of stocks is all about lower starting yield, but very rapid year-over-year dividend growth. We want to make sure that we're getting at least 10% annual dividend increases out of our single stocks in this category. If not better, some of these can get you even higher than that into the 15% range. But what we're going to be looking at here is the valuation metric, which I am taking the 4 year average yield and comparing that to what the stock is currently yielding to get this metric. And if we've got stuff in the green, we have hit that buy zone of at least 30% or more undervalued. United Health has become the major dog in tier 1. Nike held that number 1 most undervalued position for most of the first year of DGI Crab channel history. But United Health has absolutely blown past Nike as of late. The insurance giant is yielding 2.86% currently down here in the low 300s. If you look back at this one, guys, just a couple of short months ago, United Health was a stock that was trading at or above $500 a share. It has just cratered and struggled to recover. I am all in on adding to my position in United Health, getting just shy of 3% starting yield on this one. Gigantic market cap of a company. Going through it right now, it's hard to find a much better deal than United Health at these prices. I know there's negative headlines related to United Health right now. They're having their problems, but that's why they're trading cheap. Just remember that. You don't get great deals on blue chip stocks unless there's some negative headlines, some temporary headwinds that they're facing. But especially in this category, when you're looking at your 18 to 30-year-old investors, you've got a really long time horizon. Do we really think that all of this drama is going to be pulling down United Health 3 years from now, 10 years from now, 20 years from now? I certainly don't. And I think that they're going to they're certainly going to be a company that does those double digit year over year dividend increases more often than not over the long haul. And if you can get them at a starting yield this high, you're adding a lot of snow to that dividend snowball right at the beginning. Nike certainly still appealing, yielding 2.22% right now. Nike had fallen all the way down into the 50s. They've recovered back up into the low 70s. Still not the high flying $100 plus per share that Nike was a year ago at this point in time. But and as a result, their 4-year average yield has climbed. A year ago, Nike's 4-year average yield was about 1.04, 1.05. It has jumped up to 1.35 to this point because they have been down for about a year now. And maybe the average yield is going to start looking more like high ones to low twos the longer that we go. But I also think Nike is one of those companies that they are a really strong quarter earnings report away from shooting up into the stratosphere once again. Internationally recognized brand, largest shoe manufacturer on the planet. It is hard for me to look past Nike even at this point, and I am happy to continue to add to it. I still think it looks undervalued right now. Nordson, definitely still have a good opportunity to buy the dividend king in Nordson. The lowest yield of the three in the buy zone at just 1.45%, but the 4-year average yield is just barely above 1%. So you're getting a very, very nice yield on cost with Nordson, and this one has been very consistent with the high dividend increases for a very long time now. I thought we were going to get an opportunity to get Lowe's into the buy zone. They have recovered a bit this week, but continue to keep your eye on Lowe's. I certainly wouldn't mind adding to that position, but I don't want to do it at this point. It just isn't quite a good enough deal, especially not when I could be getting UNH and Nike still with a higher starting yield and just a better overall valuation number. So tier 2, our 31 to 41-year-old investors, our starting yield in this category is going to be a bit higher than tier 1. You're getting up into that 2-3% range as kind of the average, and you want to get a dividend growth rate of about 7 to 9% out of this particular group. And we've got 3 stocks now in that buy zone, as Next Era Energy has been flirting with buy zone for a little while now. They every once in a while just kind of get in there just a little bit, and then they recover and get right back out of it again. Under $71 a share is absolutely what I am looking for. Next Era Energy, excellent utility to buy, yielding right now 3.19% when the 4-year average yield is 2.45%. I think NextEra looks like a good deal at these prices. Target, Hershey, definitely still the 2 dogs in tier 2. And, Target, they may not be a fast dividend grower in the coming years as they're looking to start competing more with Walmart and Amazon, getting their online shopping experience and their warehouse manufacturing or order facilitating properties sort of up to date and closer in line with Walmart. When Walmart started doing this to compete with Amazon a while back, Their dividend growth rate really cratered, but Walmart never cut their dividend. I don't think I don't think Target is likely to cut theirs either. I just don't remember Walmart's dividend yield getting into the 4.5% range when they elected to go with the slower dividend growth route. So certainly you can get paid a nice amount with a 4.5 year starting yield to wait and see how that goes. But Target definitely continues to be very appealing to me at these prices. Tier 3, age 42 to 53-year-old investors, starting yield starts to get even higher in this category, 3 to 4% range. And then the year-over-year dividend growth slows down a little bit. We went anywhere from like 4 to 7% year-over-year growth in this category. Pepsi, Archer Daniels Midland, Hormel Foods, Genuine Parts Company, all in the buy zone. And then Johnson & Johnson, along with Pepsi, but Johnson & Johnson, one of my top 10 personal favorites because they're 20% off the 4-year average. They are also in my buy zone for this particular category. Pepsi and J&J, super stable, steady companies that you do not have to worry about in terms of their dividend security at all, in my estimation. And really, all 5 of these are good, solid dividend plays. Probably the one that I am the least excited about out of the category is Hormel, just because they've been down here in this $30 range for so long now. Their 4-year average yield continues to steadily climb, so $30 a share is starting to look very normal for Hormel right now. Hopefully they have a bit of a recovery story in them and they can get back into that $40 range at some point, but it's just been a while now. So the 3.81% starting yield, well, it's certainly not a bad starting yield to have. It just doesn't look as impressive as it used to because that 4-year average yield continues to catch up to the current day yield the longer it stays down. Tier 4, the age 54 and older investors. This is a smaller group of stocks because I wanted to pick some that I didn't think were in danger of cutting their dividend, that also had a high yield, that also consistently grew their dividend. That's a pretty, and also had a history as well of doing so. And that's a pretty hard combination to find with higher yielding stocks. So admittedly, we want to get like 5 to 7% starting yield out of the single stocks and 2 to 4% year-over-year dividend growth with this category. This is for when you really need the current day income and you're a little less concerned with large year-over-year dividend growth because you're not going to have as much time in the market to enjoy it. No obvious purchases to be made in this category this week, so this is going to be another week where the 54 and olders really ought to just be focusing on income generating ETFs instead of worrying about these single stocks. Okay, so if we go into the strategy here, this is the kind of the breakdown for how I look at it with the ETFs. And I spoke to a younger investor last week, and we talked about putting together an ETF portfolio. And I talked about the importance of really emphasizing that S&P 500. And to simplify things for that younger investor, we kind of looked at the idea of, instead of doing VOO, VBR, VIG as a trio, just really emphasizing VTI, a total stock market fund, and then pairing that with a little international. I think that either of these combinations for tier 1 can work out really well. And then for the tier 2 and the tier 3s, you start to see different allocations, different ETFs that you might focus on. These are all ETFs that I think are appropriate for these particular age ranges. For the tier 4s, you'd want to have some higher yielding ETFs, SPHY, PFFA, MLPX, Devo, JEPQ, SPY-I, all excellent options. I like to spread the money around. So if one doesn't do particularly well one year, it's going to be buoyed by another one that does. And then this would be the stock allocation for me this week. So for tier 1, I'd emphasize Pepsi and J&J first, and then I'd hit my UNH, Nike, Nordson, maybe grab a little Target. Tier 2, to Pepsi, J&J, Target, Hershey, NextEra, UNH, Nike. And then tier 3, you could do a lot of different things, but Pepsi should be the priority for tier 3 and 4. Happy birthday from DGI Crab.